IVM.
Going for parties is just so frustrating these days. I mean, your mom will make it a point to come and tell you how her friend's son has secured a house for her, and your wife will also find out that her sister's husband is taking her on a foreign holiday. While you're wondering why you're the only one who doesn't have a plan for the damn future. That's why I never sleep well during the festive time. Unless. www.hdfclife.com. Select. Done. You know what? I think I'll sleep rather well after all. Live calm. With HDFC Life, click to protect life. The Income Plus option offers life cover and steady income stream, so you're always ready for any expenses that life throws at you. Basically, this plan lets you plan your expenses like you plan your vacations. It's that simple. Visit hdfclife.com to know more and for terms and conditions.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and I am thrilled, absolutely thrilled to have Axis Mutual Fund for the very first time on Paisa Vaisa. My guest, Ashwin Patni, Head of Products and Alternatives, Axis Mutual Fund. And on this episode, we're going to talk about an all-time favorite, and especially this is the time, the tax-saving time, the end of financial year time. We're going to be talking about ELSS investing. So don't go anywhere. We'll be right back after this short break.
इन्फ्लेशन, फिस्कल डेफिसिट, जीडीपी, एमएसपी, एनपीए, इक्विटी मार्केट वगैरह वगैरह। दोस्तों, हमने सारे शब्द टीवी या अखबार में जरूर देखे होंगे या फिर सुने होंगे, पर हम में से कितने लोग हैं जो ये जानते हैं कि इन सब का सीधा प्रभाव पड़ता है हमारी सैलरी पर, हमारे इंक्रीमेंट पर और कमबख्त हमारे खर्चों पर। दोस्तों, मेरा नाम है अभिनव त्रिवेदी और मैं बात कर रहा हूँ इक्का दुक्का इकोनॉमी पॉडकास्ट से, जहाँ पे इस तरह के इकोनॉमिक और फाइनेंशियल टर्म्स को मैं जोड़ूंगा सीधा आपकी जेब से। हर मंगलवार एक नया एपिसोड सुने IVM पॉडकास्ट की वेबसाइट, ऐप या फिर किसी भी अन्य पॉडकास्ट प्लेटफॉर्म पर।
And welcome back, folks. Ashwin, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Hi, really happy to join this podcast and looking forward to the conversation.
Thank you so much, Ashwin. So let's start, Ashwin. I had a look at the Axis website and it's got this very nice theme for the ELSS scheme. It says, build wealth, save taxes. So let's go into each one after the other, right? So let's start with the build wealth part because all of us want to be wealthy. How does ELSS help us to build wealth?
So there are 2 or 3 building pieces of ELSS which we should all be aware of, which will help us answer this question. First thing is, when you have to build wealth, you have to look at an asset class that has the potential to generate strong long-term performance. And what ELSS does is it is essentially a portfolio of equities. So equity-linked savings scheme, as the name itself tells you, it is essentially a mutual fund product that invests into a basket of equity stocks. Now, as many of the investors may be aware who've already been investing, if you have not invested, many of you may be aware because you have seen in the media about Nifty Sensex, or you may have read about long-term growth in equity. Even if you've never heard of this before, the basic thing that you need to be aware is equity is ownership in a company. Now, when you are owner of a company that is a large company in a country like India, which is growing very fast. Last 20 years, India has grown at 8-9% every year, which means that if our country was 100 20 years ago, today we are 800 or 1,000. And essentially what that means is companies who are doing well, growing with the country, growing as more consumers are there, more people have money to spend, etc. And equity shares are participating in this growth. Companies that are listed on the stock exchange give us participation in this growth. And that is where the wealth generation comes in, because as investors, when we buy these equity shares, we get a chance to participate in this growth alongside the companies and participate in that over the long term. ELSS, therefore, creates wealth by giving us an access to an equity portfolio that has the potential to generate wealth.
Folks, there you go. Equity linked. Remember that ELS is only for equity linked saving schemes. That's the full form of ELSS. Ashwin, let's get into the safe taxes part, right? I mean, this is the time of the year where we get bombarded by a lot of emails from mutual funds, and also on many websites we keep on getting this 46,800 rupee number. Can you just explain to us how tax breaks work in ELSS?
It's pretty simple. Actually, I'm sure most of the investors or most of the listeners are aware of Section 80C. Essentially, it allows us, if we put our money into certain types of savings products, it allows us a chance to adjust that against the income that we show for taxes, effectively reducing our income to that extent, taxable income to that extent. The limit for that Section 80C is 1.5 lakhs, which means that, of course, we can put less than that, but we cannot, if we put more than that, it doesn't qualify from a tax saving perspective. So a maximum of 1.5 lakhs is what is available for us to allocate to savings products that qualify in 80C. ELSS is one of such products. There are a number of other options also, but the interesting thing is, and if you look at it from an equity-oriented perspective, growth investing perspective, then pretty much the main product that is in that basket, which allows you to do that, is ELSS. And it allows you, and then it's just math after that, because assuming you invest a maximum of 1.5 lakhs and assuming the tax rate is 30%, it gives you that 45, we apply with the other adjustments, etc., gives you that number that you spoke about, which is 46,800. So essentially, the magic number to me is not that, but the magic number to me is 1.5 lakhs. That is what you need to invest into Section 80C instruments like ELSS to get that saving that you can potentially get, which is the maximum saving which is possible.
Okay, so trying to understand ELSS funds, like if I go on, say, a platform like Paytm Money, ET Money, whatever it is, how do I find them, right? Are they marked, with something that says tax saver or ELSS, or do all equity schemes qualify? And if I invest in any equity scheme and hold on for 3 years, is that fine? I mean, I believe that Axis Long-Term Equity Fund is also an ELSS scheme. So could you help our listeners understand how to identify a scheme by the name, an ELSS scheme?
So SEBI, which is the regulator for mutual funds in India, they have done a great job in terms of making very transparent categorization within mutual funds. So to answer, you said 2-3 things in your question, and I'll try and cover them one by one. There are, of course, many type of equity funds because ultimately there are two parts to when you look at funds. One is where they invest, which all funds that invest in equities are equity funds. Then within equity funds, there are certain funds which are ELSS, and there are certain funds which are not ELSS, which are other type of equity funds. And they could be, for example, large cap funds, mid cap funds, any other type of funds. Investing, both are investing in equity, but the treatment for investors is slightly different. We spoke earlier about the tax saving feature, the Section 80C feature. That is only applicable to what are called the ELSS schemes, which are equity funds which are of a certain type, which get tagged as ELSS. There are other equity funds which do not qualify for Section 80C. You still get the benefit that you invest in an equity portfolio, you have growth potential over time, all the other stuff, but you don't get the 80C, which is obviously something only available to ELSS. Now, coming to the second part of your question. Now, clearly, when you're searching for it, there are 2-3 ways of searching, 2-3 hooks. ELSS is the best way of looking at it. If you look at any scheme that qualifies for ELSS, it may not have it in the name. You mentioned that, for example, the product that Axis has is called Axis Long-Term Equity Fund. So in the name itself, there is no mention of ELSS, but if we just below that, it will mention that it is a scheme that qualifies within ELSS. So any fact sheet, any form, any prayer that investors will read about Axis Long-Term Equity Fund, immediately below that, they will see that it is an ELSS. And the same is true, obviously, not just of Axis. If you look at any fund house, there are so many of them, and any of them have a product that qualifies for ELSS, it will immediately clear right below the name that this qualifies for ELSS. That is one. But however, this is an indirect method. There are direct methods. You mentioned that there are so many platforms today that investors can go to search about different schemes. A lot of them, if not all, in fact, I would like to believe all of them, today classify schemes by their categories. So you could, for example, search for equity funds as a category. But within equity, as we discussed, there are subcategories. And one of the subcategories is ELSS. So in most of these platforms, they allow you to just simply search for all ELSS. And automatically you get the list of each of the, and every fund house will have only one, because that's the SEBI only allows one per fund house. So in Axis, for example, we have long-term equity, which is just the one. So like that, you'll get the list of each of the fund houses, what is their scheme, which is the ELSS scheme or the scheme which is qualifying for that tax saving bucket for investors.
Hmm. So, last question before we go into the break, Ashwin. Very basic question, but I like basic questions. How do you invest in an ELSS scheme? I mean, what are the various methods of doing it? Can I, for example, just go on your website and say and apply for one? Or what are the various methods available to?
So I think yes, you could do that, which is to go to a website. It could be ours, it could be any partners. There are so many different websites available. There are, in fact, a plethora. I think. Host of different ways in which you can invest into mutual funds. You could do it in the old school way, which is the paper, and you can have a paper and you fill up the form and you submit the form. There are lots of what are called mutual fund distributors or investment advisors who can help facilitate the process for you. They can even help you understand what are the different ELSSs in the market, what are the pros and cons of different of them. So for an investor who needs that hand holding, there are a lot of these players who can sit down with you and make you understand. There are a lot of the more digitally savvy sort of investors. There are lots of options today on the digital platforms, whether it is the web, whether any of these apps, a lot of them have it. So a host of different ways of doing it, right from old school paper and pen to the new school app and digital approach, different options are there. The only thing you need to have is there is something called a KYC, which you need to have as a one-time thing. Anytime you want to invest in mutual fund, the process is very, very easy. For anyone who's already invested, it's a one-time process, so you don't need to do it again. Assuming that is in place, it is a 2-minute process. It is very, very seamless, very quick, very easy. I can compare it to buying something on e-commerce these days. It's the same thing.
Great. So, folks, I'm sure all of you are wondering now, the next obvious question is, how do you choose an ELSS scheme and how do ELSS schemes work? So, we're going to answer all those questions on the other side of this break. We'll help you choose a good ELSS scheme. Don't go anywhere. We'll be right back.
Do you like true crime stories?
Do you like to learn about the people behind some horrible, awful crimes?
More specifically, women that may have committed these crimes.
Actually, Indian criminals that are women?
Then we'd like to welcome you to our podcast, Misconduct. My name is Raghavi.
And I am Nisha.
We cover themes like murder, dacoity, drug trafficking, financial fraud, kidnapping, and many more.
You can catch us every Wednesday on the IVM Podcast Network or wherever you get your podcast.
And welcome back to this episode of Paisa Vaisa. Ashwin, let's get into it. First, just a general overview of how ELSS schemes work. They have a 3-year lock-in and that's it. And then after that, how do you choose a good scheme?
So basically, these are, we have a terminology in the industry called open-ended schemes. What that means is that a scheme is open for subscription on every single day. And it also means that the scheme is open for exits subsequently. ELSS is a special kind of an open-ended scheme because the requirement for the tax saving, the Section 80C, is a hard lock-in. So there is a 3-year of commitment that any investor will have to agree to. So today, when, for example, we are on 1st of January, for just to pick a date of 2022, 3 years, 22, 23, 24, entirely locked in. Maybe I'm just crudely putting 1st January of 2025. Till then, you cannot touch the money. It is locked in. You invest the money on 1st January, it's gone. But it does not mean that automatically it's not like an FD or something that on 1st January 2025, the money is coming back. You can actually choose to remain invested because the fund remains in existence. It's a long-term fund. Axis Long-Term Equity Fund, for example, has been around since 2009. There could be an investor who put his money, their money in 2009 and still are invested. It's absolutely fine because remember I spoke about the power of equity growth. It works over very long-term periods. And even though the tax thing is only 3 years, nothing stops investors to stay invested. However, on the other side, if they need the money, the power of the open-ended scheme is that on any given day, once, of course, the 3 years are open or over, they can then reach out to the fund house and put in what is called a redemption and take the money in a few days' time, processing time, once the processing time is done. So technically, going back to the example, 1st Jan 22, you invest, Jan 25, post Jan 25, till Jan 25, you can't touch it, and post Jan 25, the choice becomes entirely of the investor. They can choose to remain invested. They can choose to take the money if they need it at any given time, put in a redemption and get it. Ideally, our recommendation is to not get limited by this 3 year. Now, 3 year is only the minimum lock-in from tax purposes. It may not be just because tax puts a 3 year requirement does not mean that we have to see it as a 3 year investment. We should ideally see it as a very long-term investment, and that is what we normally recommend. See it as a 5 year, 10 year, 15 year story. That's when the power of equity growth really kicks in.
Next question was how to choose one. Yeah, I mean, how should I go about choosing one?
Which sort of dovetails into the first part, because we said that this is money that gets committed for the longer period of time. You are locked in for 3 years, which means that if you put the money and 6 months later you realize fund is not doing well, or 12 months later, it is something that you have to remain committed on a 3 year basis. It is not something that you can keep switching and changing, which means that the very important thing is to look at the different funds and see their long-term experience, the long-term performance, see that the fund houses have an approach which can remain relevant over the long period of time. See, equity is a volatile asset class. Market can go up and down month on month. Performance can be up and down month on month, which is why you have to focus not too much on what is happening day to day or month on month, but actually look for ideas which can be, or approaches which can work over 3-5 years or longer. So to short answer, it's not an easy thing for the investors who are less informed. You can take the help of, as I said, mutual fund distributors, can take the help of informed intermediaries. But if for the informed investors, I would say look at those fund houses that have delivered a good experience over the long term, that have the ability to declare out well, because you don't want to chop and change too often. You want to stay committed over long period.
Okay, just a few technical questions now. First, I think, I'm sure that there's no dividend option here. These are only growth schemes, right?
There is a dividend option or a growth option. Both options exist. Keep in mind that dividend comes only out of returns. We cannot pay dividend out of capital. So effectively what happens is that the capital remains locked in, but you could get dividend as depending on the frequency of the dividend paying of different schemes. So that is something that is okay.
And that would be taxable in my hands, obviously.
Absolutely.
And then, of course, if you're someone who's committed to the long term, and if you really don't need the dividend, then you should probably be preferring the growth option.
That is what, we recommend. As I was saying in the previous question also, equity is a growth asset class. It's called a growth asset class because the money compounds, what we call compounds over time. Means you get return on the return. Today you put 100 rupees, and if it becomes 115 next year, you want that entire 115 to work for you, not take out the 15 and again you get only 100 working for you. So that's how,
So this 3 year lock-in, just one or two questions. The first is, I don't know, let's say that, God forbid, if I have an emergency, and if I need to access those funds, A, can I access it? B, what happens then? Do I get charged for the tax breaks? Do they come back on my income tax? So how does that work, if it's possible at all?
No, so it's not possible at all. And which is why investors should be very careful. But I think the challenge is to get this going. And let me explain with an example. See, ATC is available every year. The challenge will be in the first 2 or 3 years, because what will happen is, if we have been regular in our investing, year 1 we put, that will free up in year 4. Year 2 we put, that will year 5. Year 3 we put, and after that, it is not locked in, because some part of our thing will always keep getting freed up, and that is available to us if we need it. So I think of it as a little bit of a planning for the future, a little bit of trying to manage the cash flows. Obviously, equally, people have to keep in mind that, as you rightly said, suddenly if there are demands and all that, this will not be accessible. So accordingly, they should budget and make sure that they have that spare liquidity which allows them to do it. But if they are in a happy position where they have that, then this is a great thing, because in 2-3 years you can make it self-sustaining, because it actually then keeps getting freed up every year subsequently.
Yeah. Question number 2 is, obviously I can do an SIP also. And at the end of I'm assuming that, let's say if I do, 5,000 a month. So at the end of the year, 12 into 5,000, I'll get a tax break of 60,000, or 60,000 will be eligible for the tax break. Am I right in understanding that?
Absolutely. That's the right approach. Yes.
Okay. So I can also set up an SIP. What if my fund isn't performing in that 3 year lock-in, or what do I do then?
I think so. Obviously, as I said, 3 years is a lock-in. So unfortunately, that is not something. But again, if we are regular about our investments, again, as I was explaining, ATC is not a one-time phenomena. Every year it comes. People can be smart about it. People can regularly invest. As you gave the example of an SIP, we have the phenomena that a lot of people wait till Jan Feb to make these investments, whereas you could just make a monthly SIP, and through the year you also get the averaging benefit of the equity markets, which is possible. But to answer your question, therefore, if you are regularly investing, you get a chance to diversify. So even though the 3 year is locked in part of the money, but then you make sure that when you are making incremental allocations, you are then reassessing where the money is going. And if there are some other options which are attractive, then you also allocate to those, so that you're not stuck with only one manager for the entire ELSS allocation, depending on how comfortable. If it's going well, of course, you can continue. But so while you may not touch the 3 years, but incremental, of course, you can make those actions.
And of course, let's say that if you're investing for a 10-year period, then that's ideal, right? I mean, you could
Absolutely.
do a 3-year gap, set up an SIP month by month by month, or set that up for a nice 3-year period. You'll get the entire tax benefit. You'll also get to know the performance. Maybe after 3 years, you change your mind and you want to, I don't know, maybe put in another ELSS, maybe if that is probably more closer to your philosophy. So you can do that over, if you're committed to the equities markets, and like you said, if you're generating wealth over the long term, you should be invested in the long term. So that is possible within the ELSS
Absolutely
framework.
possible. Let me give another example. You can even today, like 1,50,000, doesn't have to go in just the one ELSS scheme. Even day one itself, what people can do is split that over 2 schemes if you are not clear or not comfortable with just one scheme. So day one itself, you are de-risking yourself by allocating across 2 schemes. So there are so many different options which are possible.
So folks, there you go. Don't look at this as a Jan Feb thing just because this episode is playing out in the month of Jan, Feb or March just because of tax saving. Get in the habit, guys. Get in the habit of saving. And who knows, an SIP might work for you. Then set up the SIP. Take the tax break as probably a side advantage. The bigger thing, remember, is savings and getting into a discipline. Have I got that right, Ashwin?
Absolutely. I think the story is not the year one. Of course, that's it's helping us get us on our path. But the story is, Sensex, which was 100, in 80s, today is whatever, 40,000, 50,000. Think of that. That's the compounding that has happened in this country over the years because of the growth that we have seen, the way the companies have delivered. And that is the potential. If we invest for 10, 15, 20 years, that is the kind of potential that we have.
Great. So let me just, talking about the 3-year limit, you mentioned that you can also hold on to the ELSS for more than 3 years. Let's say that I'm in the happy situation where my fund is performing and I'm holding on to it maybe for 4 years or 5 years, and then I want to sell. What happens then? Will the redemption be liable to capital gains tax?
Yes, it will be on the gains in the year in which you redeem. So on actual. So for example, someone who had already invested in 2017 or 18 is sitting today, and let's say right now in January or whatever of 2022, they need that liquidity. And if they redeem, so it will get counted in their capital gains of this year. And whatever is their situation based on that, the capital gains tax. It will, of course, in a normal situation for most investors, the long-term capital gains should be applicable based on whatever their rate.
So there you go, folks. Just figure out what's your capital gains bracket, and then there's a 1 lakh limit, and then there is long-term, short-term. So figure that out to calculate the impact of capital gains on your redemption. Okay, Ashwin, you guys ran a recent campaign on ELSS, right? Could you just share that with us? What are any key consumer insights, any takeaways from that?
I think 2-3 things we have been trying to sort of propagate, and it's also about insights. It's also about us trying to fine tune our own messaging of how we go to the market with this. And that whole journey, in fact, I will take a step back. And the whole journey actually for us started in 2011 or 12, when this fund that we had, which was called at that time Axis Tax Saver Fund, because that's how the nomenclature used to work for ELSS. People used to focus on the tax saving aspect of ELSS scheme, and we renamed into Axis Long Term Equity Fund. And we wanted to actually focus on the long term equity aspect of it. And these are 2 sides of the same coin. We have discussed this. One side of the coin is ELSS schemes qualify for ATC, give you that benefit. The other side of the coin also is that ELSS schemes being equity portfolios gives you the chance to potential for long-term compounding that you get on equity side. And to us, for a lot of investors, the second side of the coin was somewhere getting diluted because the entire focus was on just the tax saving part and how can you just do it, and that not enough attention was being given to the power of the asset class, which is the equity asset class, and what is the potential that it can have for the investors. And that's the same learning that we had. And of course, I think there has been a sea change over the last 8-9 years since then, but some of those challenges remain in terms of not planning in advance, not looking at the power of the longer term asset class, not looking at the process, what is required in terms of the long term outcomes. And I think some of those attempts from our side has been to get that messaging going for investors to help them come along the ride, which is the long term ride of the growth in equities.
So, folks, there you go. Remember when we started this episode, and you'll see that on the Axis website, it's build wealth, save taxes. Build wealth is very important. Please focus on that. Okay, Ashwin, just to wrap up this recording and this episode, let's talk about mutual funds, the industry as such. We're in 2022. Mutual funds is now 37 lakh crore industry. I'm sure that you've been in this industry long enough to know that, I don't know, we were probably 5 lakh crore maybe 10 years ago, and it's just gone up. Some of this, of course, is because the markets go, but a lot of this is also because inflows also come in. What efforts do you think are required to take us to maybe, I don't know, the 100 lakh crore mark? How soon do you think that can happen, and what needs to happen to make it that way?
I think the important number to me is that despite all the growth that we have seen, and the exact number, I can confirm, but even today, if you look at maybe 3 to 4% of India's population has experienced mutual funds, not more.
Wow.
Maybe we can be generous and make it 5 because some people may have experienced them in the past and today have gone away. But whichever way you cut the slice, less than 5% of our population has experienced mutual funds. Now, clearly, that shows us in a way, it's the negative, but also the positive. That shows the potential that is there ahead of us. If we can keep, taking this message out to more and more people, as more and more people see firsthand the power of the growth potential of some of these instruments, some of these things that have been delivering what they've been doing last 20, 25, 30 years, and really that. So I feel sky is the limit. Clearly, like I can speak for Axis, for us one of the biggest things, we very recently we're very excited because we crossed 1 crore folios last quarter, and that is one of the most successful in terms of, if you look at the number of investor base that we have, is one of the best in the industry.
So congratulations. One crore is a big number for a mutual fund.
Absolutely. So for us, that's been a big passion project, saying how we get more and more people to start experiencing this. And clearly, I think people, even if they experience small, once they get into the habit, once they see the impact in their portfolios, they will keep coming back for more. So I think that's the power. That's really the future. Get more and more people exposed to the idea of what the mutual fund investing is about. Make sure that we have all the relevant products, which I think the industry has done a good job. But I think the better thing is the requirement is more the communication, reaching out to more and more people, getting them to start participating.
Mutual funds, sahi hai. Ajay, I'm going to just sneak in one more question out here. Since you spoke about habits and we're talking a lot about discipline, savings, SIP, stuff like that. What do you think are good habits to inculcate in mutual funds, right? Because when I have conversations with people, generally they're all chasing performance. Some fund is good because it's performing well. Some funds are not good because it's not performing well. And now, of course, this entire passive active thing. If I were to ask you, for our listeners, maybe 2 habits, 3 habits, 5 good habits when it comes to mutual funds, what do you think is these good habits could?
I'll tell you. So number one habit is there has been a lot of work people have done to understand performance over the years. And the simple summary of that, and not to get bogged down in numbers, but bulk of any investor's performance or portfolio returns will not be driven by whether in equities you're choosing fund A or fund B or fund C. It will be driven by what is called asset allocation, the long-term asset allocation. Whether you are in equity or debt or gold, where is your money? For example, you could be in the worst performing equity fund in the last 15 years. Or you could have been, just to give a contrast, in an FD or some other instrument. That will drive, not the fact that you were in the better. So what investors spend too much time thinking about fund A versus fund B versus fund C. Let me 3-6 months. If it is not working, let me try to change this, that, chop change. Don't spend enough time in thinking, in my portfolio, if I have 100 rupees, should I put 60 rupees in equity? 50? If we just put 5-10 rupees in equity, we heavily under allocate. And then we focus too much time in chopping and changing that and not enough on, the long-term potential. So I think the most important rule, the most important thing is start from the top, look at your portfolio, look at your wealth, make sure you create the long-term plan of saying that if my wealth is X, I want it to reach Y in 10, 20 years. Let me put aside a meaningful allocation to equity if I have the ability to do so. And then monitor that top-down allocation rather than worrying about chopping and changing very, very frequently.
And that is seriously good advice. I mean, when you think about it, just staying the course, right, Ashwin? I mean, first, of course, like you said, figuring out, okay, I'm going to put whatever 50, 60% in equity and whatever 40% in debt. That actually is more important to long-term returns rather than getting obsessed about within equity. Have I got the right scheme or the wrong scheme? Have I understood that right?
Absolutely. And then staying the journey. As you rightly said, I think 100% the most important thing. Figure out step 1, figure out the journey. Step 2, stay on the journey. Don't get too worried. I think most of the time, unfortunately, and that's a reality of equity markets, which is very unfortunate, is that they are volatile. They will keep shocking you every year. There will be some event which will lead to the markets going up and down. The media will be screaming about it. As investors, we will start worrying about it. We'll look at our portfolio. We say, oh my God, it was X then, and it has fallen by so much. What should I do? Should I panic? And some of these are instinctive reactions. Nobody is happy, looking at our portfolio and saying it is down. Wow, great situation. My portfolio is down. Good one. Everyone will be sad about it. But how do we make sure that we protect ourselves for taking bad decisions because of that instinct? Stay the course. Make sure we stay committed. Make sure we have regular features like SIP running. Make sure we don't track too often. Make sure we stay the course. Make sure we do much more. We don't start every day looking at our portfolio valuation. Doesn't help really anyway. All those things, get the right habits to really stay the course. But most important advice, stay the course.
There you go, folks. Can't get better than that. Keep your discipline intact for the long term. Stay the course. As they say, time in the market, much more important than timing the market. And that is a wrap. On this episode of Paisa Vaisa, my guest, Ashwin Patni, Head of Products and Alternatives. Ashwin, thank you. Thank you so much for doing this for our listeners.
Thank you for having me.
And listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcasts on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Hello. It's been another great week on the IVM Podcast Network. On Raw and Organic, Kunal talks to Shivjit Gatke and Zahir Khan about how they came up with Step Set Go, a bootstrap startup. On Khel Niti, friend of the network Saurabh Pant joins Rajiv Mishra, Ayaz Memon and Sabah Karim to preview the India vs Sri Lanka series. On Paisa Vaisa, Anupam speaks to Ram Iyer. He is the founder and CEO of the Viant Network. They discuss how trade finance works for local shops and SMEs. What is an oblate spheroid? The Simplified hosts deconstruct the American football game and all there is to it. And on the Filter Coffee podcast, Karthik is in conversation with the Delhi High Court advocate Rohan Alva. They talk about his book, Liberty After Freedom, a history of Article 21, due process, and the Constitution of India. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. It really helps us. Don't forget to rate us on any of the platforms that you're listening to. And also remember, you can check us out on YouTube at www.ivmpodcast.com/YouTube. And finally, we'd like to thank our sponsors this week, Bank of Baroda and HDFC Life Insurance. Thank you so much for making this possible.
A wise man once said, traveling, it makes you speechless, then turns you into a storyteller.
Well, listen to such travel stories and experiences exploring India on the Musafir Stories with us, Saif and Faiza.
Catch us on the IVM website, app, or wherever you get your podcasts from.